Hi and welcome to Swissquote's Daily Market Talk. It's Monday, April 28th. The week starts with limited optimism for the US assets and the US dollar, as the de-escalation of the trade tensions doesn't necessarily change the expectation that the first quarter shake to the international trade will hit the US economy and probably boost consumer prices for the US. But before we go, please keep in mind that opinions that I will be sharing in this video are my own, and this is not financial advice. So the week starts with mixed feelings, really. Market mood has improved last week as the US President Donald Trump eased pressure on the Fed President Jerome Powell. Remember, he also announced some progress with some major trading partners, including Japan and India, and said that the triple-digit import taxes on Chinese imports will probably be substantially revised lower. And happily, we heard no major bombs from Trump or his administration during this weekend. So it could hardly get better than this, provided the situation. So the week starts with some optimism, limited but some optimism still. China said, for example, that it's confident that it could hit its 5% growth target this year, deploying suitable policy and fiscal response. On the individual front, if you missed that, BYD, so Build Your Dreams, the Chinese EV maker, announced last Friday that it doubled its profit in the first quarter of this year to roughly 1.3 billion US dollars. So that's more than 3 times the money that Tesla made last quarter. And the company's shares in New York jumped more than 5% on Friday and closed the Friday session some 4.30% higher. Alas, the BYD shares are down by around 4%. This morning in Hong Kong. Tesla on the other hand jumped almost 10% on Friday's trading session only, and more than 25% during the course of last week, despite announcing a 70% drop in its net profit. Now, the CEO Elon Musk's announcement that he will spend less time at the Doge department helped, along with the news that the transportation department's new framework in the US on crash reporting demands, and also the fact that they will be expanding the types of autonomous vehicles that can be tested on the streets in America, well, helped boosting sentiment. Self-driving cars are exactly where Elon Musk wants to make a difference with his Tesla cars moving forward, along with the humanoid robots, of course. But I am not sure that the latest news are worth a 25% jump when the brand value of Tesla has taken a decent hit on Elon Musk's political implications in the US and beyond the US. Anyway, this week starts on a mixed note, as I said earlier. The Chinese equities are actually quite flat this morning, despite the Chinese government's efforts to boost stimulus to boost growth in China. The Japanese Nikkei index, on the other hand, trades lower this morning at the early hours of the new trading week. The Bank of Japan is expected to make no changes to its monetary policy when it meets this week, but the hotter than expected inflation numbers that have been released in Japan on Friday actually fueled the hawkish BOJ expectations, and the Japanese yen's recent strength against a broadly softer US dollar also makes the Japanese companies more expensive for international and foreign investors right now. As such, the Nikkei is down by more than 10% since its January peak, and the index has room to extend its fall, and the dollar yen also remains offered around the 144 mark, mind you, weighted down by a broadly weaker US dollar amid concerns over the wide economic damage expected from Donald Trump's tariff policies in the US economy. So the pair will likely retest the 140 psychological level to the downside and has all the reasons in the world to make a substantial move below this level. In the United States, the S&P 500 posted its second best week in 2025 last week, so that's quite good news. The mega flow of bad headlines, especially on tariffs this weekend, is encouraging, in fact, but the US futures are pointing at a soft and negative start to a week full of earnings right now. Last week, remember, as I said, Tesla gained 25% despite bad earnings and a gloomy outlook. But Google, for example, announced encouraging advertisement and cloud revenue growth in the first quarter of this year. So this week, oil giants in the US and 4 of the Magnificent 7 companies will be reporting their own earnings, and their results could potentially throw a floor under the Trump-led sell-off in the US if Donald Trump doesn't spoil the market mood, of course. I mean, that's the thing of the moment, right? There are the earnings, there are the economic data that are being announced every day, but there's also the Trump factor. And unfortunately for everyone, Trump tends to weigh heavier on the market mood than the news on prospects of rainy days ahead due to the tariff uncertainty. Because look, I actually came across a chart showing the impact of the latest tariff escalation between the US and China. And the chart actually shows that the cargo ships leaving China in destination of the United States actually dropped by more than 30% since April 2nd. That's the time Donald Trump announced his tariffs to the world. That and the fact that the Chinese goods will see their prices rise significantly in the US in the coming weeks are not necessarily encouraging. We are talking about triple-digit price hikes for the Chinese imports. A set of 10 kitchen towels on Shein, for example, is posting a 377% price increase, as the US will no longer keep the so-called de minimis exemption for small value shipments that was in place for such a long time, and that actually benefited to the small value shipments. So it will be very interesting to watch the supply chain disruptions that we might have due to the trade war, potential shortages of goods on US shelves, and also the impact of these shortages on overall inflation and growth in the US, as the consumer spending makes up to around 70% of the US GDP. Speaking of which, the US will reveal its first reading of the first quarter GDP this week. And a consensus of analyst estimates on Bloomberg actually suggests that the economists expect the US economy to have grown by just 0.4% in the first quarter of this year, and that number compared to a 2.4% growth printed a quarter before Donald Trump entered the White House. So if you think that that's a soft number, well, that is still much better than the 2.5% decline that Atlanta Fed's GDP now forecast predicts for the first quarter growth for the US. And the impact of tariffs are just due to the uncertainties for now. They haven't even taken effect just yet. Note, however, that a bad GDP figure from the US this week could at least encourage the Fed to cut the interest rates sooner rather than later. So we have already started to hear some Fed members shifting toward that thinking last week, remember. Hence, a soft GDP figure from the US this week could further revive that hope and give a certain support to the markets, as a 2.5% decline of the Atlanta Fed GDP has already been widely priced in across the major US indices. I mean, the S&P 500 fell nearly 10% in the first quarter of this year and fell up to 20% after the April 2nd's tariff announcement. So we could see at least some correction if the GDP number is bad and Fed is likely to step in. Across the Atlantic Ocean, we will have a close look at the early CPI updates for the major eurozone economies in April this week. The softer the data, the higher the expectation of ECB rate cuts to provide support to the underlying economies, and the better the appetite will be for the euro and also for the European assets. So the euro and the European index futures are slightly better bid this morning at the time I'm talking here. In contrast to the US dollar and US futures are softer this morning, hinting at a potential return to the divergence in appetite that we have been seeing in the first quarter of this year. But this time, this divergence could be driven by diverging inflation outlook that could eventually allow for a more supportive European Central Bank policy while keeping the Fed quite inflation cuffed, really. So this is all for this Monday. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on our new WhatsApp channel, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.